All right. What is up, traders? What's up, tycoons? Super excited for today's video. We're going to break down what's going on in the stock market, right? We're going to actually go through all of my internal metrics that I look at to really understand the market's movements and where things are heading. We're going to start off with a little bit of seasonality first, and then we're going to break down into some things that really you're not going to find anywhere else on YouTube or, even online for the general part. So be sure to smash that like button, subscribe to the channel. Remember, none of this video is meant to be considered as financial advice. This is rather just informational and educational and going over a lot of the different things that I look to, measure the market. Now, the first thing we're looking at here is the seasonality average in purple. All right. And we have this purple pinkish line down here. We're trading in summer right now and we're approaching fall and then going to be heading into winter in the blue. All right. Green is obviously going to be spring. And so what do we see? Well, we see that, this is September right here, basically the beginning of September. We see that the stock market tends to bottom out towards the later half of September. And, right now we're rallying, right? So, it does say that we have, we are supposed to top out, seasonally, in the middle of August. But, rather what we're seeing is we're actually seeing the stock market push up a little bit. Now, this isn't meant to be used as a, 100% guarantee, but more of just an outline, right? So looking at it from a seasonality standpoint, it would make sense if we start to pull back in the, middle of September sometime. It could happen before then, it could happen after then, but historically, that's what the trend has been. September is also, historically the worst month for the stock market. And now that August is over and we're heading into September, I think that it's important to bring up some of that information. Now, when we take a look at what the projections have for us, okay, they do actually have us going higher here currently at the moment. This is the seasonality projection. A little bit of a different tool, different indicator that we're looking at right here. And this is for the S&P 500. Now, this is a little aggressive and it says that, we could potentially take out our new highs, but look at the timeline, right? This dotted line right here is actually September 15th. And this also kind of agrees with, us topping out towards the middle of September and then getting in that pullback towards the later half of September into October before finding a bottom and actually rallying. We'll take a look at the NASDAQ real quick too, and take a look at the NDX. And we see also something very similar, right? We see, the seasonality projection is a little aggressive with us putting out new highs towards the middle of September. I don't know if I, necessarily agree with this totally, right? But this is just something that I look to help me understand some of the market's movements. And it says that, we could potentially still go higher heading into it. Now, what are some of the big factors that we really need to see, for this to happen? Well, one thing that we can look at is going to be credit spreads. Okay, so if we take a look here, right, and we kind of just zoom in, and we don't even need to zoom in on this chart, honestly, but what we have on the bottom is going to be the H by G to IEI ratio chart. This is kind of a form of looking at credit spreads, all right, and then we have the SPX on the top here. And the reason I'm showing this to you guys is because each time we see pullbacks in the market, right, we see the credit spread chart also dropping here too, right? And what have we been seeing? Well, we've actually been seeing this chart go up while the S&P 500 has been pulling back. And if you take a look, we're actually breaking out of a downtrend right now, currently at the moment. And we still have a low or a high and then a lower high here. Meanwhile, over here, we've had highs, higher highs, and slightly higher highs here as well. So, this is kind of telling us that, hey, maybe this pullback is not really justified, right? And that's why we're seeing a lot of this market rallying is, when we look at credit expansion and the credit spreads and different things like that, it's kind of telling us a different narrative than what we were seeing here in the market. We're seeing a little bit of a divergence. Another thing that I really like to look at is going to be the four pillars, right? The four pillars, look at what they're doing right now. They look very strong here currently at the moment. Now they're still grappling and battling with overhead supply. But if we zoom in on all of these, all right, what do we see here on? So first off, the four pillars are going to be tech, right? XLK, and then the SMH. The SMH is very, pivotal for the tech sector in general. And then we have XLI here. This is your industrials, followed by XHB. This is your home builder. So home builders are a big part of the industrials and semiconductors are a big part of tech. And if you're seeing the S&P 500 rallying, you want to see tech and you want to see the industrial sectors rallying as well. You don't want to see these two lagging behind while the S&P 500 is rallying. That's going to indicate that maybe this rally isn't justified. And what are we seeing here on our weekly time frame? Again, we're battling with that overhead supply on many of these charts, but we saw a strong bounce off of support, right? That's exactly what we got. Strong bounce off of support here, strong bounce off of support here, strong bounce off support here, and a strong bounce off of support here. And all of them are entering back into this overhead supply zone. So the big question is, can we get a breakout retest push up higher on all of these charts? Or, are we going to continue to grapple with this overhead supply and really just consolidate in here before seeing the next move, whether it's a breakdown or a break up? That's really the big question right now. But we're seeing lots of follow through in the market with the four pillars, right? This is a weekly chart, and all four of these, candlesticks look very strong, except for the XLI. So we want to pay attention. If you're watching this video on Thursday evening or Friday morning, tomorrow, you want to pay a lot of attention to XLI in the industrial sector, right? If this candle goes down even more, that could be a warning sign, all right? Being that these are the four pillars, you need all four of these to perform really, to justify the movement in the market. And then, that's my opinion, but it's also a little bit fact-based just by data, right? And looking at, the data of these four. So pay close attention to XLI tomorrow and the industrials. Another thing that we can look at here is going to be TLT and SPX, right? Take a look at the bond market. TLT has been a leading indicator oftentimes for, for the markets, right? If we just zoom in a little bit here on this chart, so it's even more clear for you guys. What we had was we had these times where whenever we see a divergence, okay, and so TLT is actually going to be on top here, and then we have the SPX down here. At this period here, we're making these lower highs. Meanwhile, the S&P 500 is making these higher highs. And being that TLT is going to be a leading indicator, it kind of suggests that the S&P 500 should be due for a pullback, right? And that's exactly what we saw, right? We saw the S&P 500 actually pull back after this divergence. And then yet again, we saw the same thing where, the S&P 500 is making these higher highs, TLT was making these lower highs, and, that kind of suggests to us that we should see a pullback in the market. And that's exactly what we got. Now, these divergences and, using TLT as a leading indicator doesn't mean that the market's going to crash and create new lows. If you see here, TLT is the one actually making new lows versus the S&P is actually making new highs. But it's just kind of an indicator of like, okay, well, is it a time to be cautious? Is it a possibility that we get a pullback in the market? And that's exactly what we got after using TLT as a leading indicator for the S&P 500. You can also do the same thing with the NASDAQ and actually taking a look at HYG, right? This is your high yield corporate bond ETF, or I'm sorry, for the tips is what you want to look at for the NASDAQ. That's what I like to look at. And you can see the same thing, right? We're seeing, the tips ETF making these lower highs while the NASDAQ's making these higher highs. And then that suggests that we should get a pullback, right? And we see a pullback in the NASDAQ. Same thing over here. We're seeing these higher highs in the NASDAQ while HYG, or I'm sorry, the TIPS ETF TIP is making these lower highs here, suggesting the NASDAQ should make a pullback, and we have gotten those pullbacks, right? So, there were lots of signs for a market correction, especially after such a strong rally and entering a new bullish cycle, right? A new bull market, which we have done. Right, if you take a look at the NASDAQ from the lows to the highs, it's rallied over 20%. That's the definition of technical definition of a new bull market. It makes a lot of sense that we got a strong correction here, right? And I mean, it wasn't even nothing crazy. The NASDAQ dropped about 8% or so when taking a look at the NASDAQ 100 index. And so we got a healthy correction, right? And there were a couple signs on tips and the NASDAQ ETF on TLT and the SPX ETF. But, can we sustain this market rally? So one thing that I like to look at here is just a measurement basically of, is the market going risk on or is the market going risk off? And one way that I measure this is by taking a look at the S&P 500 here on top, and then also taking a look at consumer discretionaries versus consumer staples, right? So this is a ratio chart here of consumer discretionary to consumer staples. And then this is our XBI. This is the biotech ETF. Now, why do I say that this is a way for me to measure if the market's going risk on or risk off? Well, biotech is arguably the most risk-on asset class in the stock market or the risk-on sector. These are profitless companies, oftentimes looking to get FDA approval, looking to get patents and different things like that. And then once they get that, then they actually become profitable. So to me, it's arguably one of the most risk-on sectors. We can see that it's got a little bit of an inverse bump and run pattern with the prevailing downtrend. Then you have the bump down in price. We got the first breakout, and we're looking to see if we can get the second breakout. If we can get the second breakout, then it's very possible we could see some of these charts and really justify some of the seasonality stuff that we're looking at, right? When we're looking at the seasonality projection, what do we see? Well, we see that it actually has us continuing to rally into September. And when we're breaking down our market internals, we're seeing that the four pillars looked good. We know that XLI industrials was lagging behind. But when we go back to our risk on, risk off chart here, which is actually, that was the wrong one. It's going to be right here. What we need to see essentially is just a breakout in the XL or XBI in the biotech sector. If we can get that breakout, we've already gotten the breakout here in consumer discretionary to consumer staples. We've already gotten the breakout here on the S&P 500. Take a look how last time when we had the same setup where the stock market was pulling back, discretionary to staples was pulling back, and XBI was breaking out. We needed both of these to break out for us to truly, take out the new highs, right? When we look at the S&P 500 and we started the downtrend on all of these charts, we didn't take out the new highs until both of these, right? And in this case, biotech actually broke out first and started leading the rally, and then the consumer discretionaries to consumer staples chart. And so we finally started to see consumer discretionaries break out, and look at what happens there. That's when we actually broke our highs that we were stuck below. All right. And that's when we had the next bullish push up. So for right now, we do have some highs here around 45.92. Let's just round it up and call it 4,600 on the SPX. If we want to take out those new highs, we're going to need to see the XBI sector break out, right? With this inverse bump and run pattern. We've already broken the shorter term downtrend, and we need to see the breakout here. Again, we've gotten the breakout in the discretionaries to staples. Amazon had a really nice day today. And if we can get this combined with the biotech sector breaking out, then it's very possible we could actually break through our 4,600 area there again, which lines up here with the seasonality projection. Now, these are all just things that we need to happen, for us to actually, come up to these areas, right? It's not a guarantee. It's what to look out for to potentially suggest that, hey, this is a possibility and we could actually go up there. Now, before we move further in the market, I do want to highlight Tesla real quick. Okay. Tesla has had an amazing move to the upside, really breaking its downtrend that it was stuck in. You can see it's been trading in this downtrend, had a very strong breakout. The reason I'm bringing this up is because I actually have a completely free newsletter. So, you can get these newsletters straight to your inbox. There's also a website and you can go back and read all of the posts there. But we highlighted Tesla in, the top trade ideas. This was 10 days ago, right? And we talked about Tesla with its downtrend. We talked about the 5-day moving average. Okay, if we were to, just look at this chart right here, I have some Tesla call options that are up about 70% right now at the moment. So, those are looking really good. And I just wanted to bring that up because, you can sign up for it using the link in the description or in the comment section down below. And again, it's completely free to you guys. And it's also a great way to support the channel. And that was a really good trade opportunity. There's been other really good trades in the newsletter as well. And I try to put out at least a couple trade ideas every single week on top of just overall investment intelligence in different things that I like to go over. Now, when it comes to trying to navigate the market on a day-to-day basis, you don't always have to force the trade, right? And so if we take a look today, I only made one trade today. It was a very quick trade. We'll go ahead and maximize this real quick. And so you guys can see, essentially what it is that I was looking at. But, You don't need a million trades, right? That's basically like the point that I'm trying to make here. And you don't have to feel like you need to force trades or do anything silly like that, right? And so there's a very simple setup that we had today that I was looking for in the market. Lately, I've noticed that waiting until around lunchtime Eastern, waiting till around 11:30, 12, is really when I start to find my best setups. Now that just works for me. Some people like to trade the open, but I've really gone against trading the open. And what we had here was a very simple inverse cup and handle, right? So, we had, inverse cup, then we had inverse handle, and I actually entered in on the rejection of the VWAP, and, was able to catch this very nice move down. All right, quickly close that trade for 75%, trading S&P 500 put options, not the futures, but I actually like to chart up the futures. And I just want to break down, the trade possibility here, right? So the first thing that went into my mind, and I mentioned these in some videos, is we have a rounded top here. Okay, this is not a bullish sign to me. Now we did bounce, okay, off of a strong support level right around 45.25, right around this area. We can see that buyers are stepping in. But I'm seeing that we have this rounded top up here, and I'm looking to see, are we going to reject VWAP, right? Which is going to be my purple line in this area. And, that's exactly what we ended up doing. Okay. We ended up coming right up here to VWAP, and this is a liquidity grab. Okay. So, this is market makers essentially stopping out everybody that entered here, 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 and here at the VWAP. They push price up, 5 points above the VWAP, stop a lot of traders out. And what do you see? You see the huge move to the downside. Now, how do I know this is a liquidity grab? Why am I saying that? Well, because look what happens directly afterwards, right? They need the liquidity for this huge push to the downside, right? This is a 5-minute chart, and these are 6, 7 point, 8 point candles, right? So we're moving very quickly to the downside in a very quick matter of time. And the inverse cup and handle actually played out very nicely. As soon as we broke through our main level right around 45.25, we had a strong push to the downside. So, just kind of want to highlight some trading strategies in here too, while we talk about the overall, feel of the market. What's another thing that we can look at? Well, this is the SPX up here on top. And then we have the consumer discretionary to consumer staples. And then we have the credit spread chart right here as well. And, what are we seeing, right? Consumer discretionary to staples looking strong, breaking out. What are we seeing here on the credit spreads? Looking strong, right? We're not seeing a big pullback here to the downside, right? We saw the pullback here. We saw the pullback in discretionary to staples, but we didn't see it here on our HYG IEI chart. And now we're seeing, these play catch up, right? Essentially is what we're seeing. We're seeing the S&P 500, catch up, right? We're seeing the discretionary to staples chart catch up, to some of our other internal metrics that we use to really measure the market. So I think I'll go ahead and wrap the video up here after this last chart. This is the S&P 500, and then the percentage of stocks above its 50-day moving average, 20-day moving, or a 50-day moving average, and a 200-day moving average. And for us to really go bullish, right? For us to continue and keep trying to rally like that seasonality chart suggests. I mentioned to some people, I talked about it in the Discord a little bit. We needed to see the percentage of stocks above their 200-day moving average above 50%, right? And that's what we've gotten here. We're starting to see some follow through. We're starting to see the percentage of stocks above their 200-day moving average above 50%, but we haven't seen it here yet on the percentage of stocks above their 50-day moving average. So, for us to get that next push up, we really need to see, the percentage of stocks above their 50-day moving average get up to 50%. Right now, it's at 43%. The percentage of stocks above their 200-day moving average is at 53%. If we were to zoom in just a little bit more over here, we are starting to get a bullish crossover here with some of our moving average indicators right here. We're seeing we have the green line crossing above. That's usually a bullish signal, versus when you see the green line cross below the blue line, that's usually a bearish signal. So we'll see, can we get some follow through? Big catalyst tomorrow. We have non-farm payrolls that could throw a wrench in a lot of these things. But hopefully you enjoyed today's video, and if you did, smash that like button, subscribe to the channel, and don't forget to sign up for that free newsletter using the link in the description or the comment section down below.